welcome to the FinGlimpse podcast, where we analyze the world of business, finance, and the economy. We cover the latest market news, economic trends, and some interesting businesses. As a standard disclaimer, this podcast is for informational purposes only and should not be considered investment advice. Always do your own research. Now, let's get started.
You know that feeling, right? Scrolling through the headlines, seeing markets jump or drop on the latest policy whisper, trying to figure out what it all means for your investments. It's easy to feel overwhelmed by the sheer noise out there.
It really is. Information overload is a constant challenge. And distinguishing what's truly important, the signal from the noise, well, that's absolutely crucial right now.
And that's exactly why we're doing this deep dive today. We're not guessing. We're going straight to a specific, well-researched source, the Standard Chartered Global Market Outlook Report from May 2025.
Right. Our mission here is really to cut through the report's complexity. We're going to pull out the most important insights, the core arguments, and give you a clear picture of their investment views specifically for June and, well, looking further down the road.
And this report lands at a particularly interesting time, right? Right after some pretty significant and frankly volatile shifts in U.S. trade policy that have had markets.
Well, guessing.
Definitely an interesting backdrop.
Okay, so let's just jump right into the headline. What's the absolute big call Standard Chartered is making in this report?
Their headline call is quite clear, and it's a significant one. They are upgrading global equities to overweight.
Overweight, wow, that's a strong positive signal, especially after some market turbulence related to those policy shifts we just mentioned.
It is.
What are the primary reasons they give for this increased optimism?
They spell it out pretty clearly. The core reasons cited are, first, easing U.S. trade policy risks, which is a big one after what we've seen.
Huge.
And improved market technical indicators, suggesting momentum is picking up.
Okay. And they also seem to be anticipating more trade deals ahead, right? Seeing that as something that could sustain this rally.
Yes, that's part of it. And importantly, they point to relative resilience in economic activity data, what they describe as the hard data.
As well as surprisingly robust corporate earnings estimates. Even with some economic concerns floating around, companies seem to be holding up better than some expected.
So for you listening, when they say overweight global equities, it means they're recommending allocating a larger percentage of your portfolio to stocks globally, compared to what a standard benchmark might suggest. And these factors, trade tensions, potentially easing, technical strength, resilient earnings, are critical because they're addressing some of the biggest uncertainties and, well, fears that have been weighing on markets.
Precisely.
All right, so they're positive on global stocks overall, but markets aren't a monolith, are they? Where specifically are they seeing opportunities within equities?
Exactly. They don't just say buy stocks. They have specific preferences. For instance, they are upgrading U.S. equities to a small overweight.
Small overweight on the U.S., okay.
Their view is that the Sell America trade that we saw earlier this year was, well, probably overdone, especially given how well U.S. corporate earnings have held up.
That's interesting. They like the U.S., but then immediately follow up by emphasizing the importance of diversification. Why stress diversification so much, even when pointing to the U.S.?
Well, because even with the preference, the outlook isn't without risks, and opportunities exist elsewhere.
Right.
Within Asia ex-Japan, for instance, they remain overweight China. They point to policy stimulus happening in Beijing and the expectation that the U.S. dollar might soften, which usually benefits emerging markets like China.
Okay. And what about other major regions like the Euro area, Asia ex-Japan overall, India, Japan?
Those are viewed more as core holdings. The rationale varies a bit, maybe attractive valuations in places like the Euro area, growth prospects and stimulus benefits in parts of Asia, and things like corporate governance improvements, driving potential in Japan. It's really about spreading bets even within a generally positive equity view.
Okay, now this is where it gets really specific. They mention opportunistic ideas within equities. These sound like their conviction calls on specific sectors or indices. What are those picks?
This is where they narrow it down, yeah.
Yeah.
In the U.S., they are bullish on software, communications, major banks, and notably semiconductors. That semiconductor call is a new one for them.
Semiconductors. Okay, well, given the global tech trends, especially AI, that makes a lot of sense. What's the core rationale behind those specific U.S. picks?
It often links back to broader themes, as you said. Semiconductors are tied directly to the ongoing AI trend. All right, so The chip's power, the whole AI revolution.
Right.
Software is liked for its pricing power, meaning companies can potentially maintain or even raise prices, even if the economy slows a bit. Communications benefits from online entertainment and more AI applications.
And major banks.
Major banks, well, they see those benefiting from a potential soft landing scenario for the economy and perhaps some possible deregulation down the line.
Got it. Okay, what about outside the U.S. for these opportunistic sector calls?
Elsewhere, they like China, non-financial high-dividend SOEs, essentially, state-owned enterprises with strong domestic exposure.
Yeah.
These could benefit directly from government stimulus, and they also offer attractive dividends, which is key. They also favor the Hang Seng Technology Index, seeing it supported by AI themes and attractive valuations after previous declines.
And Europe. Anything specific there?
Yeah, European banks are on their list. They're seen as potential beneficiaries of German stimulus, maybe, and offering good dividends, too.
Okay.
European industrials also make the cut, expected to benefit from infrastructure and defense spending increases. So you see, these aren't just random picks. They're tied to specific macro or policy drivers they identify.
Makes sense. Okay, shifting gears completely now. What's the outlook for bonds, for fixed income? With yields having risen so much, are they still attractive in this view?
Yes, the report's view is that high-quality bonds do remain attractive at today's elevated yield levels. They hold them as a core position in portfolios.
But they mentioned a specific downgrade, though, right? Developed market government bonds moved to a core holding from potentially something higher before. What's that about? And yet they still call current yields an attractive entry point. That seems a little nuanced.
It is nuanced, yeah.
Yeah.
They move them to core, perhaps indicating slightly less conviction than before. But the key point is that at these current yield levels, they still offer a compelling return compared to historical levels.
Oh, okay.
So they see them as an attractive entry point precisely because yields are high now, and they expect yields to fall from here in either their soft landing or, frankly, hard landing scenarios.
That makes sense. What are the risks they flag for bonds then?
They highlight two main risks. One is an unexpected surge in inflation expectations, which could potentially be triggered by things like those tariffs we discussed earlier.
Right, the trade policy risk again.
Exactly. The other is lingering concerns about the U.S. fiscal deficit, which was underlined by that sovereign rating downgrade we saw some time ago. While they see the latter as more of a tail risk, maybe without an immediate trigger, it's still on their radar.
Okay. So similar to equities, are there specific bond types or regions they're highlighting as opportunistic, more specific calls?
Yes, they have specific opportunistic ideas within fixed income, too. They have new bullish calls on U.S. 20-year plus government bonds, seeing good value further out the yield curve with that longer duration.
Longer duration play, okay.
And they also like UK gilts, specifically FX unhedged ones, seeing a good yield pickup there and potential benefit from expected Bank of England rate cuts down the road.
And they also maintain some existing bullish calls, I think.
That's right. They continue to be bullish on U.S. agency mortgage-backed securities, often referred to as MBS.
MBS, yeah.
These are bonds backed by pools of mortgage loans, typically issued by government-sponsored entities, and they can offer diversification and yield benefits. They also still like U.S. Treasury inflation-protected securities, or TIPS, which obviously provide protection against unexpected inflation.
So the takeaway for bonds is yields are attractive now. They serve a role in the portfolio, but watch out for potential inflation surprises or those long-term U.S. debt concerns.
Exactly. Still attractive, but with specific risks and specific areas of higher conviction.
Okay. Let's round out the asset classes with gold, FX, currencies, and oil. What's the view there? Starting with gold.
Right, gold. They made a change here. They've actually downgraded it to a core holding.
Downgraded gold after the run it had. Why?
The reasoning? Well, they expect a period of consolidation after the really significant rally we've seen. They're also noting signs of maybe buyer fatigue, particularly among Asian investors, who were a big driver of the recent price surge.
That's interesting, but they still seem pretty positive long-term, don't they?
Oh, absolutely. Despite the near-term view, they maintain a strong long-term view on gold. They're still targeting $3,500 an ounce in the next 6-12 months.
Wow, $3,500.
Yeah. They see structural tailwinds like central bank demand still firmly in place. They even put a new, higher baseline floor price expectation for gold, somewhere around $3,000 to $3,100.
Okay.
So near-term pause maybe, but long-term still bullish.
Okay, okay. How about currencies? What's the outlook for the US dollar, the DXY?
On the currency front, specifically the US dollar index, the DXY, they actually expect a near-term rebound. They see it heading towards 103 in the next 3 months.
A rebound, so a stronger dollar near term. Why is that?
They attribute that to things like renewed appetite for U.S. assets driving flows, maybe, and a normalization of investor positioning after recent moves, just kind of a technical bounce back.
Got it.
Yeah.
But does that near-term strength last?
No, they expect that to be temporary. Their longer-term view, looking out 6-12 months, is for the dollar to weaken, targeting 98 on the DXY.
Okay, down to 98. What drives that?
The drivers for that longer-term view include the potential for rotation out of U.S. assets as other economies maybe pick up steam, and again, those lingering U.S. debt concerns. They also briefly touch on other currencies, expecting the euro dollar to recover somewhat, the Singapore dollar to ease slightly near term before maybe edging higher, while the Chinese yuan is seen gradually weakening.
Okay. And finally, crude oil, WTI. What's the forecast there?
For WTI crude oil, they expect a near-term rebound as well, targeting $64 a barrel in the next 3 months.
$64 near term. Okay.
This is supported by shifts in investor positioning, they think, and potential effects from China's stimulus flowing through.
So a bounce is expected. But their 12-month forecast, I notice it stays the same.
That's right. Despite the near-term bounce expectation, the 12-month forecast remains unchanged at $60 a barrel.
Why the flat longer-term view?
The core reason is their projection that a global supply surplus in oil is expected to persist throughout 2025, keeping a lid on longer-term price increases. They do, of course, note Middle East geopolitical risk as a key potential upside risk that could change that picture.
Always the geopolitical wild card with oil. Okay, so we've covered the specific asset class views, equities, bonds, gold, currencies, oil, but all of this happens within a broader economic and policy environment. Let's circle back to the macro backdrop. The report highlights that recent U.S. trade policy flip-flop. How significant was that?
Oh, it was very significant both in itself and for market sensitivity. The report details how we saw tariffs increased, then suddenly a 90-day pause announced, and then talk of potential trade deals.
Right.
Total whiplash. And the market reaction was stark. The S&P 500, for example, fell about 20% at one point during that volatility before recovering. Yeah. It really underscores how policy uncertainty is a major factor right now.
And they identify two key event risks coming up that could influence things further.
Yes, two big ones they focus on. First, the expiry of that 90-day trade policy pause in early July. What happens then? That's a big question mark.
Definitely.
And second, the ongoing economic data they point to, the divergence between resilient hard data, like actual manufacturing output or retail sales, versus weaker soft sentiment data from surveys.
Why is that data divergence a risk? Doesn't resilient hard data mean the economy is fine?
Well, it means it has been fine, but the soft sentiment data can often be a forward-looking indicator, right?
Oh, okay.
The divergence is a risk because the weaker sentiment might be flagging potential future weakness that hasn't shown up in the official activity numbers yet. It just makes the outlook less certain and harder to read.
Got it. Okay, so with all that uncertainty and those risks, how does a report help investors navigate it? They lay out potential scenarios, right, to frame the possibilities.
Exactly. To help investors think about the potential paths forward, they outline 3 distinct macro scenarios and assign a probability to each one.
What's the most likely scenario in their view? The base case.
Their core scenario, which they assign a 50% probability, is a soft landing.
Okay, soft landing. What does that look like?
In this scenario, growth slows down, but we avoid a full-blown recession. They expect the Fed to start cutting rates in the second half of 2025, a scaled-down tax bill passes, and trade negotiations actually yield some positive results. Volatility is expected, especially near-term, but corporate earnings provide support for equities.
Okay, 50% chance of that. And the other 2 possibilities, the alternatives.
There's the hard landing scenario with a 25% probability. This involves a recession hitting in the second half of 2025, possibly made worse by an escalation in trade tensions.
And what would that mean for markets?
Well, this would be negative for equities. They see the S&P 500 revisiting previous lows, potentially falling towards 4,500. Bond yields would likely be capped by that environment, and really only defensive assets like short-dated bonds, gold, and other safe havens would offer much refuge.
Ouch. Okay, and the third scenario, also at 25%.
That's the no-landing scenario.
Right.
This is where the U.S. economy actually recovers, gets back to trend growth, maybe tax cuts and deregulation boost business sentiment, and trade deals are finalized successfully.
And the market impact there, Sounds much better.
Oh yeah, strongly positive, particularly for U.S. equities. They see the S&P 500 potentially rallying significantly, even towards 7,000 in that case. It would also be good for riskier types of bonds.
Wow, those potential outcomes are dramatically different. An S&P 500 target of 4,500 versus 7,000, depending on which path we take. That really highlights the uncertainty.
It really does.
And I guess understanding these distinct possibilities shows exactly why they're stressing the diversification and careful positioning across asset classes and regions so much.
Absolutely. Each scenario has profoundly different implications for your portfolio, which is why being diversified, having exposure that can perform reasonably well, or at least not get crushed in different environments is just so crucial right now.
The report also mentions drawing insights from their quantitative models. How do those data-driven approaches factor into their overall view? Are they confirming the fundamental story?
Yes, their quantitative models inform both the overall asset allocation and some of the tactical calls. For instance, their stock bond model maintains a slight overweight on global equities relative to bonds.
And I noticed the report mentions this is driven by valuation and technical factors in the model. Even though fundamental factors are currently negative, that's a bit counterintuitive, isn't it?
It is a little. It shows that their models are picking up signals from areas like relative market valuations or price trends. The technicals that are currently outweighing some of the fundamental concerns the model might be flagging elsewhere.
Interesting.
Their technical framework, for example, gives them short-term bullish signals on specific equity markets like China, the US, and the UK for the next 1-3 months, based purely on chart patterns and indicators.
And they also looked at investor positioning, like how crowded trades are.
Right. They note that investor positioning in gold and developed market investment-grade government bonds, which had become quite stretched and overbought after those rallies earlier in the spring, well, that positioning has normalized somewhat after recent price pullbacks.
So less risk of a snapback just because everyone was on one side of the boat?
Exactly. It suggests less risk of an immediate sharp reversal purely due to crowded trades. So these data points add another layer of analysis informing their overall views.
So between the complex macro backdrop, the different potential scenarios, and these signals from their quant models, the report comes back again and again to one central theme: diversification.
They absolutely hammer this point home. They stress that active diversification, not just across traditional asset classes like stocks and bonds, but across geographies and even different investment strategies, is essential for navigating this complex and uncertain outlook.
And they even give an example of why this matters in practice.
Yes, they mention how their diversified strategies were designed to deliver lower drawdowns, basically smaller losses during downturns, compared to more traditional, simple portfolios during recent volatility.
Right.
It underscores that diversification isn't just a theoretical concept. It's a practical tool to help protect your wealth when things are unpredictable.
Finally, the report includes a section that feels a bit different. It touches on broader principles for managing wealth, framed around today, tomorrow, and forever. How does that fit in with all these specific market calls we've been discussing?
Well, this is where they connect the tactical views back to sort of timeless principles for managing your own financial journey. It's a reminder that while market outlooks like this one are important, they are part of a much larger long-term plan.
Right, the bigger picture. And what are some of those core principles they highlight there?
They talk about discipline, sticking to your investment plan even when markets are volatile, diversification, which we've discussed extensively and how critical it is now, time in the market, emphasizing that staying invested over the long term is generally more effective than trying to perfectly time market entries and exits.
A classic. Yeah.
Classic. Also, risk and return, making sure the level of risk you take aligns with your long-term goals, and protection, safeguarding your wealth against unexpected events.
It's almost like they're saying, okay, here's our best guess based on all the data and analysis right now. But remember these fundamental rules because things could unfold in very different ways than our base case.
Precisely. It's a framework to help you align the market outlook with your personal long-term goals, recognizing that navigating uncertainty requires both informed positioning and enduring principles.
So this deep dive into the Standard Chartered global market outlook gives us a really nuanced picture. It's fundamentally positive, you could say, on global equities, driven by their assessment of easing trade tensions and resilient corporate fundamentals.
Yeah.
But it's definitely not a simple all-clear signal. It's layered with very specific regional and sector preferences, acknowledging ongoing uncertainties like that looming trade policy deadline and the conflicting economic data signals we talked about.
It's a very calculated view, weighing up the drivers and the risks they see quite explicitly.
And the report doesn't shy away from the possibilities, does it? Explicitly laying out those three potential scenarios, soft landing, hard landing, and no landing, each with wildly different outcomes for asset classes.
Yeah, the range of outcomes is quite stark. So given how unpredictable policy and economic data can be, thinking about navigating the markets ahead, how does considering multiple potential futures like these shape your own strategy? And perhaps reinforce the importance of being prepared for more than just one outcome?
That's all for this episode of the FinGlimpse podcast. If you found our discussion insightful, please consider subscribing and leaving a review. We'd love to hear your thoughts and suggestions for future topics. Until next time, stay informed and make smart decisions. Goodbye.